Hey, everybody, good to be here. It is Wednesday. What a week we've had. Hey, it's managing an options portfolio. We'll talk about various types of options trades and some different things. And I'm going to focus on this particular topic today as well of setting multiple targets or multiple stops on your options trade. So we're going to get to that in just a bit here. But let me just mention a couple things. One, I'm joined by Ben Watson in the chat, helping me out. I appreciate Ben. If you have questions, feel free to type those in the chat. And between Ben and myself, we'll do our best to get your questions answered. Also, you can follow us on X at BrentMooreCS, at Ben Watson CS. Also, if you are, if you live somewhere near a bigger city, check out our events calendar because we may be coming to an event near you. Schwab.com/events will take you there. And Ben Watson, you'll see Ben Watson in the flesh there if you do that. So that's great too. Hey, before we get too far into this, let me just mention a few important things. And that is options carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the material today is intended for general informational purposes only. Rolling strategies can entail additional transaction costs. And the paper money software application is provided for educational purposes only. For the sake of simplicity, I'm not going to factor in commissions in all the trades that we look here, but just realize commissions and fees are a real thing that you should pay attention to. All investing involves risks, including loss of principal. Schwab does not recommend the use of technical analysis as the sole means of investment research. Past performance is no guarantee of future results. There we go. Okay, let's head on over to the Thinkorswim desktop software. And look where we're at. We're up almost 1% today. So, you look at the chart here, and yeah, the S&P 500 has been kind of, sideways channeling. But looking here, you're going, well, war, what war, that kind of thing. We had a big dip yesterday, but the big thing with the dip was we extended down a lot. By the time we ended up the day, we were right at the bottom end of the channel. So that channel is still kind of holding true here. And, a lot of it, I don't know what the future holds, right? It's just a bit news. The market is news driven. And so I don't know what's going to happen, but, we're going to just look to do trades and demonstrate things. And, one thing that I want to show you is when you're doing trades and considering your money management, when you're managing your options portfolio, a lot of times you may have more than one contract that you trade. And when you do more than one contract, that opens you up to the possibility of having different exits. You think a stock's going to go up to a certain level. Let me pull up a stock here. I'm going to pull up Coinbase, okay? And just a reminder as we talk about Coinbase, because a lot of it is derived from crypto, the value of Coinbase is derived from crypto, that digital currencies are highly volatile and not backed by any central bank or government. Digital currencies lack many of the regulations and consumer protections that legal tender currencies and regulated securities have. And due to the high level of risk, investors should view digital currencies as purely speculative instruments there. Okay, so let me just get that out of the way. But for a lot of traders who want some kind of exposure to the crypto market, we'll look at Coinbase. And of course, crypto, we could look at a chart of Bitcoin. I'm not going to, but it's had quite a tumble, and Coinbase, right in line with that, has tumbled. It looks like it's maybe reversing course here. We're above the 50-day moving average today for first time in a long time. We've been above the 20-day for a few days now, and that 20-day is starting to curve up. And, nice, strong move here. That being said, I just want to kind of do a sample trade, and these are all just sample trades. And I'm going to just do a long call. We're going to keep it simple here. But I want to consider this. I actually have a couple lines drawn on the graph already as potential target levels. This one is going to be kind of where our old support was that we broke through. That could be new resistance. I'm going to consider that kind of my T1 level. Target 1 is what we'll call that level. And as more of a conservative exit. But if it continues to go up, I'm going to say, hey, maybe this kind of older possible resistance is going to be my T2 level, my target 2 level. How can I do a trade where I enter in this example, a long call, and say, I want to get out of some of the contracts if we hit our first level, but other contracts if we get out of the next level? How do we do that? And similarly, at the same time, we'll probably put in a stop here. Okay, and I'm going to put a stop in, we'll say somewhere below today's low. Okay, so somewhere down here. All right. So first of all, let's just kind of figure out prices that we're dealing with here. This T1 level or target 1 level is going to be about 226. And I'm going to jot these down here real quick. That's going to be about 226. And this level up here is going to be right around 260. Okay, so that's going to be my next target. That's going to be my target 2 level. And I'm going to put my stop down below today's low. We'll give it a little wiggle room here on this, but right around 190, I'm going to put a stop in there. Okay. So let's look at a potential trade here. I'm going to go to the trade tab. Here's options, and I'll go out to the monthly options. I'll go up 44 days on this. And I'm going to go in the money here a little bit. So we can go, let me just do this. I'm going to use delta. Delta tells us how much the option is likely to move in relationship to a $1 move in the underlying stock price, but it can also give us kind of an indication of how far in the money, how far out of the money it is. I'm going to go up to about a 64 delta here on this. And I'm just going to look at this trade, and I'm going to, now if I'm normally going to do buy with a target and a stop, what I would do is I would right click on it and I would say buy custom with OCO bracket. Buy custom with OCO bracket. That's a target, that's a stop, but that's not what we're looking for. We're looking for 2 different targets and 2 different stop, and a stop. So how do I do that? So I'm going to do something here that is, we're going to change this, that is going to tweak it a little bit. I'm going to go to advanced order, and I'm going to go to first triggers to OCO. And when I do so, it doesn't initially do anything, but it tells you, it says there should be 5 orders in here. So here's my target, and I'm going to just create another one of those. And here's my stop, and I'm going to create another one of those. And now I have an entry and 2 targets and 2 stops. So let me just kind of illustrate this for you, just kind of schematically, if you will. So we're going to enter our trade here. Okay, so we're going to say enter. And we're going to say, if the stock goes up here, we have target 1. And if it goes up here, we have target 2. Okay. And then we're going to have a stop down here. Okay. And what we're going to do is we're going to do an OCO. And so it's going to say, if we go up, we're going to get out, and it's going to get out of our stop, but we're only going to get a half of that. We're also going to have a second target, 2 OCOs. And ultimately, if the first one hits, it's going to cancel our first stop. Or if the first stop hits, it's going to cancel our first target. We can put these stops at the same price, though, the same level. So I'm going to say stop 1 and stop 2 are the same level. So we have 2 OCOs, OCO 1 and OCO 2. If OCO 1 triggers, it's going to cancel out these. Okay, it's going to, let's say the stop hits, it'll cancel out the target. If if the stop hits, it's going to cancel out the other target. So in other words, an OCO is one cancels the other. And what we can do is we can do it so that the whole purpose of these is that we don't have, once we hit our target, we want to get rid of our stops, or vice versa. We don't want all these sell orders going on at the same time. So let's look at this again here. If I'm looking at this trade, and I can do this based on the option price, which is what I have right here, okay? Or for our purposes, so here's an option price, here's a target price, here's a target price, here's a stop price, here's a stop price. I can do these based on the underlying stock though. Let me show you how I can do this based on the underlying stock. Because when I was looking at this, I said, hey, we're going to get out if the stock hits up here. Not the option price, but if the stock hits here. We're going to get out if the stock hits up here. So let's do it. So how do I do this? I'm going to change this target to a market order. I'll make it good till canceled. Okay. In fact, I'm going to make all these market orders because we're going to put the exit based on the stock price, not the option price. And we're going to make them all good till canceled because I don't want the orders to expire in just, a few hours from now. I'm going to go to the gear and I'm going to say, click on that. It brings it up in a different window. And we're going to say, we're going to get out of this Coinbase if we hit greater than or equal to, I wrote it down, $226. That's going to get me out of this. Now, I'm going to do more than one contract, though. There's going to be two contracts of this one. We're going to get out of one of those two contracts if the stock hits 226 or above. Okay. Where are we going to get out on the sell side? Well, we're going to put a stop in, or it's actually technically not a stop, but it's a rules-based order that's effectively going to do a similar thing. We're going to get out if coin marks less than or equal to, and we said our stop was going to be 190. 190. We're going to save that. Let me just double check. I put that greater than or equal to, didn't I? Yeah, that's greater than or equal to. Okay. Our second target is going to be, I'm going to click on my gear. We're going to say if Coinbase, this was our second target, is greater than or equal to 260. Click on save. And our second stop is going to be the same as the first one, which we said if we mark less than or equal to 190. Save that. Okay. So when we buy, we're going to buy two contracts of this, assuming the order fills. If we go up and hit our first target price, we're going to sell one of those contracts here. It will also cancel the stop that's associated with it. We'll still then have one contract. There. If the stock then goes up to that other contract price, we will sell out our other contract. And then it's going to cancel out our second stop order. Conversely, let's say we buy these two contracts and the stock goes down and hits our stop level, or what we're calling our stop level, the exit if we go down to 190. This is going to fill, and this is going to fill, and both of these are going to cancel at that point. So we'll be out of the trade entirely in that point. So that is how you can do this. Now, I just did this I'm doing this based on the underlying stock price. We can also do this, and I'll show you an example here of doing one based on the option price too, okay? So we're going to do that here, okay? So let me go and I'm going to, let me just go back up here and I'm going to look and look to buy this, confirm and send, and just make sure you read through this. You can read your order conditions. This is off the top of the page, but make sure you read through each of these and then you can go and put this in, and this is just going to be a single option and we're going to send that, okay? And so, and it just filled. So we now have a Coinbase position, a bullish Coinbase position. So let's do one example here of using the the option price instead of the stock price. Now, question in the chat. What are the pros and cons of doing it based on the option price versus the stock price? In this example with Coinbase, we said we're going to get out if the option goes here, okay? The answer, if the stock goes here. But there's a challenge. We don't really know exactly what the option price is going to be at that point, do we? Similar here, if we hit up that target, or similar if we hit our stop. We don't exactly know what that option price is going to be. Now, we can do things to try and kind of anticipate it. We can go to the trade tab and we can go to the Theo price, add Theo price, and we could say, well, if the stock goes up, let's see, the stock's at 211 right now, the stock goes up $15, and I don't know, 5 days pass or something like that. Let's see, we'll go a week. I can look at what the Theo price is here on my options, and I can kind of estimate. And in this case, 27.65 up to 36.19. That's just an estimation. We don't know exactly what's going to be. So that's one of the cons here of using this order based on the underlying stock price. We kind of lose track of that. There's a disconnect. But there is an advantage, and that is we can tie our exit based to the technical analysis on the stock chart itself. If we put it in based on the option price, we're not really looking at where the stock is necessarily. Now, we can do the same thing and kind of estimate, but we don't know for sure. So anyway, that's kind of the main pro and con. And keep in mind, these are market orders I've put in. So we don't know exactly, it's going to just turn to a market order if the stock goes up to a certain price or down to a certain price. Now, let's look at a different example here, and we're going to do it based on, this is Carnival. Okay, so here's Carnival. Obviously, it took a hit. Concerns with Carnival Cruise Lines. This is the cruise ship with, possible impacts on travel with, well, two impacts. One, travel. Are people going to travel as much with war? And oil prices can certainly affect the cost of running. Cost of crude oil can affect the industry as well. So it took a big drop. So I'm going to make it more of a speculative trade here and say that, yeah, it's dropped, but we hit this support and seemed to bounce off support fairly strongly, okay, with this candle yesterday. And I'm going to assume this maybe was oversold a little bit and it may move up. I don't know for sure, but that's kind of the premise of this trade. So if I want to do that, I can go to Carnival. And again, you can use whatever expiration you want. Let me go out 29 days here. And I can look here. And I'm just going to go in the money a little bit. And I'm going to buy, buy custom with an OCO bracket, but it's not an OCO bracket. We're going to do a first triggers 2 OCO brackets because I'm going to put in 2 stop prices on there. So I need 5 orders here initially. I'm going to create a duplicate order. I'm going to create another duplicate order. So now these are going to be linked. They're going to be linked like this. These two, this is our buy order, first of all. The first triggers part of the order, the first triggers part of this 2 OCO order is it all becomes active if we end up buying this first. If we don't buy the initial contract, none of these other orders matter because we're not even getting in this. But once that buys, we have our first OCO and we have our second OCO. I'll put OCO 2 there for these two. So this is my limit price in my first OCO, or limit price is going to be the target. Okay? Stop price is going to be the scenario to try and protect us, but it's not, not a guarantee on that. Limit price, target, stop is to get us out there. Let's do this. I'm going to change my exit orders to good till canceled. And I want to put this in based on the stock price. Excuse me, based on the option price. Here's my entry. And I'm going to say, this is more of a spec. This is a lower priced options trade. It's likely to move a bigger percentage either for us or against us. So I'm going to say if I can get a 50% gain, that's going to be my first target. Now, a 50% gain on a stock, that's a very big move. On an option, it actually can happen frequently. Of course, you get bigger, quicker losses too on that option. But I'm going to take that. Our entry price, 237, and I'm going to multiply that by 1.5. Okay. And I got 355. I'm going to make this as my target, 355, my target. That's a 50% gain on that. Does that make sense there? And what about our stop? Well, let's hold off on the stops here for a sec. Let's go with the other target. I'm going to be more ambitious on this target. I'm going to make this 100% gain. So 2.37 times 2 is about 474. Okay, so I'm going to put a limit price of 474.74. What about my stop? I'm going to put a 50% stop here on this. So 237 divided by 2 is going to be about we'll say 120. 1.20 stop. These are based on the option price, not the stock price. I have 2 OCOs. Now, before I send that, let's just kind of look at this scenario. We're looking at this contract here. I'm going to use this Theo price, and let me just reset it. And I'm going to say, well, what would it take to get that 100% profit? Is that even realistic? I'm just going to move this up a little bit. We're going to say, what if the stock goes up $2? What I can do is I can then say, well, where is the current price? 220. If the stock goes up $2, we're already at 350. That's not quite at the 100% gain. That would have triggered our first stop though. And $2 move, that's less than a 10% move on the stock. Is that realistic? A $2, a $3, a $4 move? Well, let's look at the chart. $2 move would bring us up to about here. That doesn't seem unrealistic here, given this chart. May happen, may not happen, but that doesn't seem out of the realm of possibility. To get to the 100%, where we got the we said $4.40. Let's move this up. Let's say $3. And that's almost there. How do I get this to 440? They're close enough. 440. Okay. About a $3.27 move in that price from where we're currently at. So that's about 31.75. That's about here. So that's a more ambitious target. So when you're doing your trades, you may consider both having multiple targets. Now, if I wanted to, I could also add in multiple stops. I could change the stop and do one at 120 and one at, 90 cents or something like that. I could do that. But at this point, I think you understand how to do that. So that's how you can add in that. Consider that when you're doing multiple contracts, having multiple targets on that. So let's, I'm going to confirm and send. I'm going to make this, again, I'm going to put this in our long single options bucket, and I'm going to send that trade. Okay, and it filled. So that now we have our trades. Okay. Do you have any questions on that? If you do, great, put those in. Otherwise, I'm going to go and look at some other types of trades here and talk about management of other types of trades, not just long single options here. So if you have questions, now is a great time to get those in. And let me just mention this. There's a survey link in the chat, everybody. So we appreciate your feedback. Fill out the survey. Give me, if there's a particular topic or question you have, you can put that in the survey and I'll try and hit it up in future webcasts. And other than that, we do appreciate your feedback here. Okay, so here's what I'm going to do. I'm going to go here, and what I do each week in this webcast, if you're not familiar with it, is I try and tackle different types of option trades and discuss their management, just to give you a variety here, so you can see how we can manage different trades. And one that's, so I may not cover every type today, but as we go week to week, we talk about a lot of different types of trades. Okay, what is this trade I have on Bristol Myers? What kind of trade is this? This is not an iron condor. It looks like an iron condor, doesn't it? In a way, we got higher strikes, we got lower strikes, we got the same expiration. But notice iron condors have calls and puts. Iron condors have calls and puts. This has two call spreads. This has a long call vertical right here. This has a short call vertical right here. These two, short call vertical. So this is what we call just a condor, not an iron condor. Often we use the term condor and we kind of mean iron condor. This technically is just a true condor trade. Okay, so how are we going to manage it? We're actually going to manage it pretty similar to an iron condor, to be honest. We're going to kind of consider these separately. My bull call spread and my bear call spread. So we'll look at managing those separate. So Emo, question on picking strike prices. We'll get to that in just a minute. Good question. Thank you. On this trade, though, what do we want? That's always a question on whatever trade you're doing. Doesn't matter the type of trade. What's our goal? Bullish, bearish, neutral. In this case, we want it to be above our bull call spread, 62.50. We want it to be below our short call spread, the 65. So we really want this to be between 62.50 and 65. So that's what we're going to look at. Now, someone's saying, Wiley's saying, let's look at the risk graph. We can look at the risk graph, but keep in mind, this condor trade is going to look a lot similar to just an iron condor. Let me go to BMY here. Hold on one sec. I can type. There you go. That's the risk graph. That's what it looks like. We said we want it to be between 62.50 and 65. Where are we right now? We're kind of on this lower end of the range here right now. So we're a little bit bullish on this. We don't want this to continue to go down. Right now, in terms of managing, we're up a little bit on this trade. We've got 16 days to go, so there's no urgency. You know, generally, if we're under 10 days, we'll look to get out. But we still have some time. But at this point, if we're looking at this trade and we're saying, I'm bearish on this, we'll look at the chart in just a sec, I probably want to exit this trade at this point. If I'm neutral, I'm okay. We could stick with it. If I'm bullish, we're okay. We could stick with it. But so let's look. Am I still neutral to bullish on this? You can use your technical analysis. What I would say is we have a trend. And the trend's been going up. We bounced off that 20-day moving average. I would consider this still to be relatively bullish from a technical standpoint. Of course, this could reverse course any day now. There could be news that could change it. Even without significant news, it could shift directions. But so I'm willing to stick with this. Now it does say we've got an exit order on this. Let's just look at it real quick. BMY. Let's see what we got. We got an exit if the stock goes less than 60. Okay. Is that still relevant? When you are managing your option trades, you may consider at times adjusting your stops as the trade goes. The initial trade was, if this breaks below 60, we're going to get out. I think it was just this kind of support level. Well, we kind of had a higher bounce here. I'm willing to move this up a little bit with the time coming up. So this may not need that much adjustment, but I kind of want to show you the process here anyway. If I want to move this up from, say, 60 to stop to 61 to get out at that point, here's what I'm going to do. I'm going to right click on the order. I'm going to cancel and replace it. And I can say, well, I want to get out if this goes above 61. I'm going to get out of that trade. If I wanted to, I could say, look, I don't want this to go up too high. We'll get out if it goes up too far. So I can add another line to this. I can say BMY marks greater than or equal to, I don't know, 65. So we're amending, we're adjusting, changing this exit order on this to get us out on that. Okay, canceled the old order. We now have a new stop on this. But right now, this is a neutral to bullish trade, and the technical analysis is telling me it's still neutral to bullish. Does that make sense on that? Let's move on to another one. We have another one here in another Condor, actually. Okay, we'll look at this is another one here. Now, this one's not doing so well. We're actually down a little bit, not a ton, but we're down a little bit on this, $18 overall. And we have 16 days, so no urgency to get out. Let's use the same test, though, that we did on the other one. We said we want the stock to be between, let's see, our bull call spread is 62.50. We want the stock to be between 62.50 and 67.50. If that still seems like a reasonable scenario, we're going to stick with it. Yeah, we can, we're down a little bit. That's just part of the risk of a trade. That's okay. 62.50 to 67.50. Let's look at Nike here. Okay. Still, look, this one isn't going so great. 62.50 and 67.50. Now, it certainly could bounce back up here, but at this point, we're in a losing position if it stays where it's at. That's different than that BMY trade. If it stayed where it was at, we're okay. If we're neutral, this we really need a strong move up. If I can get out of this trade, okay, if I can get out of this trade right now with a limited loss, $18 or whatever, that sounds like a reasonable reasonable scenario to me on this. So one thing I could do is we could just get out of one side of the trade and not the other side. However, if I do that, this is the more losing side of the trade, so I'm not going to be realizing that gain here. Furthermore, how much more, just isolating right now on this bear call spread, how much more can I make on this bear call spread right now? Current price of these two together, about 9 cents. Okay, that means the best I can do, if we were to stick with this and it were to expire worthless, is this $9 better than I am right now? Probably not worth it in this case. I'm just going to get out of this whole thing. Now, if you're getting out of these multiple leg, these 4-leg option trades, iron condors, maybe even butterflies or other type trades, often we'll get out of not all of it at once. We'll get out of, I'm going to highlight those two. I'm going to create a closing order, and I'm going to get out of that trade to start. Okay. Send. We're out of that. And now I'm just going to follow it up with this. Highlight it, right click, and we're going to get out of this. Why am I getting out one leg at a time? Often it's easier to get fills if you, I guess I said one leg at a time. It's not actually one leg at a time, one vertical at a time on that. Often it's easier to get filled on that than trying to get someone to fill the whole shebang at once. Okay, so those are condors. Let's move on from condors here. Let's look at the management of, let's go some short verticals. Here's Apple. Apple, we have, what do we have? We have a short call vertical. This is a bearish trade. One of the rules that we've used in this webcast is when we're under 10 days to go to expiration, we got 9 days to go to expiration, we just get out. We'll take this profit, albeit a small one, here at this point. So we're just going to look to get out of this. Now, let's say we had more than 9 days to go to expiration. What would be the parameters? One, are we still bearish on it? That'd certainly be a question to ask yourself. If the answer is no, we may look to get out. If we've made almost everything we can make, well, we still actually have a fair amount we can make here. There's still this is still worth about 60 cents here. So yeah, we have a little profit here, but there's actually more meat on the bone, so to speak, we can make on this. But at this point, I'm going to follow the rules that we use in this class, and under 9 days, under 10 days, we're going to look to get out there. Okay. So let me highlight this. Let me close this order. I'm going to buy this back. Now I'm going to hit up a couple questions here, and then we'll look at some other trades. Okay, there was a question I skipped before. This was referring to the stock, to buying a long call. The question was, this was from Emo, how to pick the strike price. Well, let me just encourage you. Number one, I'm going to give you a very extremely brief conversation on that, just because we have other things we're going to go through and it warrants a longer conversation. But we do have a Getting Started with Options webcast where they talk about long calls, where they probably go in more depth. But very often with long calls, we may go in the money a little bit. In other words, let's say we were looking at Apple for a long call, and I'm looking at my strikes. I look at the current stock price, about $265, and this is $265, and I may go a little bit lower strike price. That's how we often do it. You can go to a strike price that's higher than the current price, but that's considered to be a more aggressive, more risky, more speculative trade if you do that. So often we'll start with at the money, that is the stock price that's closest to the strike price, and then just go in the money a little bit, maybe a 60 delta, maybe a 70 delta. I'm hoping that helps you with that trade there. Now, am I going to have a problem closing the spread if one of the legs is 5 cents or less? Yes, that's a good question from Harry there, and I appreciate you on that. It depends on how liquid the stock is, and sometimes it can be difficult if the price is near to zero. I want to say 5 cents or less, but if you get something that is like a penny or something like that, sometimes it can be a challenge on that. But if it's that price anyway, look, it's probably just going to expire worthless at that point anyway, and you can just hold on to it until the price, it either just does expire worthless or it does go there. So I wouldn't say necessarily 5 cents or less, but as you get really low price, sometimes it can be tough to fill those. There we go. Okay, let's move forward. Let's look at another type of trade we have here. This is NVIDIA. This is just a short put. Now we're doing quite well on NVIDIA. We only have 2 days to go to expiration. The strike is 180. The current stock price is 183, so it's still questionable, especially with the volatility we have. If we were just doing this short put as a standalone strategy, given that we only have 2 days to go to expiration, we'd probably look to get out. However, this is a particular strategy we're doing called a wheel strategy. Okay, I put that note in there just to remind myself. The wheel strategy is we sell the put with the intention of, if it does go in the money, or if we get assigned the put, assigned the stock, then it's okay. We'll then turn around and sell a cover call on it. So if you're just looking to sell the put, we could close this out, take profit. There's one other choice, and I'm probably going to have to finish with this other choice here because we're running out of time here. But the other choice is this. We could roll this. We could say, hey, I'm going to buy this put back on NVIDIA. Let's look at NVIDIA real quick. NVDA, NVIDIA. We could look at this, just shrink this down a little bit, and say the 180 strike, it's going to cost us about $150 to get out of this. But we could sell, I don't know, go out 16 days. Look at the 180 strike. That's like $570. So that's that would be a nice little credit rolling that out. So is it right or wrong? What's the best course? I don't have an answer for that. You could just get out of this, especially if you don't want to risk assignment. You could do the wheel strategy where we're fine being assigned. That's fine too. Or you could also roll and just kind of use the short put strategy and keep rolling out and keep bringing in a credit. Those are absolute fine alternatives on all of those. Because I already established that this was going to be a wheel strategy trade, I'm just going to stick with it. Okay, so that's the reasoning on that. But if you're doing this in paper money or something, you can consider rolling that. That would make sense. Just a reminder, we do have a survey link in the chat, everybody, and I want to thank Ben. Remember to follow Ben on X, at Ben Watson CS. My X handle, at Brent Moore CS. I try and post each day, something, each weekday at least, on X. And, I appreciate you joining me. Coming up next, we do have trading price patterns. And each week, we didn't hit, there's different types of strategies we didn't hit. I was planning next, I was going to get to calendar spreads and butterflies. Didn't get to that this week. Next week, we'll likely get to those because I try and give you some variety each week in terms of managing your option portfolio. But really what we talked about today to start out was multiple targets, multiple exits possible, and possibly entering more than one contract at a time so you can have those more aggressive targets and more conservative targets. All right, everybody. Hey, thanks for joining me. I appreciate your time, and we will see you all same time next week. Bye-bye, everybody.